Japan is 3 days away from triggering the biggest shift global markets have seen in decades. That's right, next week a single decision taken in Tokyo could hit your portfolio, your pension, and the price of almost everything that you own. Because Japan is about to switch off the world's cheap money machine. After nearly 30 years of being a rather dull corner of global finance with endless near-zero interest rates, a flat economy, and nothing particularly exciting going on, Japan is about to flip the script. On June 16th, the Bank of Japan is expected to lift its policy rate to 1%, the highest level in roughly 30 years. And in doing so, it will turn off the tap that's been flooding the markets with cheap money for decades. So today, we break down why Japan is taking this step, how the global carry trade unravels when it does, and why this lands squarely on your money. My name is Nick, and this is the Finance Bureau. Back in 1995, Japan cut rates to almost nothing, and it never really looked back. By January 2016, it had gone further, pushing rates into negative territory, joining the ECB, the Swiss National Bank, and Sweden's Riksbank, which had all moved below zero in the preceding 2 years. Put simply, for decades, borrowing yen has been about as close to free money as it ever was, and this created something very strange. Japan became the world's lender. With cheap money at home, Japanese investors, pension funds, and insurers shipped capital everywhere else on Earth, chasing higher returns. Today, Japan is the single largest foreign holder of US government debt, sitting on roughly $1.19 trillion of it, which is down from around $1.4 trillion at the start of the year as repatriation flows have already started. So this was never really a local story. Japan's actions had consequences for the global financial world. But that cheap money system only works while rates stay on the floor, and right now the floor is cracking. The reason is inflation. Japan's underlying trend inflation, the gauge the BOJ actually watches, hit 2.8% in April, accelerating and sitting well above its 2% target. For the first time in over 30 years, wages are following. This year's spring pay negotiations delivered base pay increases of around 3.5%, the strongest in decades, with real wages now positive for 4 straight months. And that 3.5% figure is the one that matters because it tells the BOJ this inflation is becoming self-sustaining rather than a passing shock. And then there is the yen. The currency is stuck above 160 to the dollar, a level that Tokyo treats as a red line. Japan spent a record 11.73 trillion yen, which is around $73 billion, trying to defend it in late April and early May. And yet it barely moved. Now, a weak yen sounds great for exporters, but Japan imports its food, fuel, and raw materials in dollars. So, a sinking currency supercharges inflation. As one State Street strategist put it, intervention buys time. It doesn't turn the tide, and the real pivot has to come from the central bank. Which nicely brings us to the trade that 30 years of free yen built underneath the entire market. This is the carry trade, and it is the single biggest hidden leverage point in global finance. Here is how it works. You borrow yen at near zero cost. You convert it into dollars, and you plow that money into anything that yields more. US Treasuries, the S&P 500, emerging market debt, even Bitcoin. And the profit in this trade is called the carry, which is the gap between what you pay to borrow and what you earn. And with US Federal Reserve interest rates sitting at around 3.5%, while Japan sits at 0.75%, that gap is roughly 300 basis points of free money. Now, Morgan Stanley pegs the core of those positions at around $300 billion. But honestly, nobody really knows the true number. Some estimates run into the trillions once you include derivatives and off-balance sheet exposure. And that opacity is exactly what makes it so dangerous. And no single institution fully understands its scale. And now this trade only works on two conditions. First, Japanese rates stay low, and second, the yen doesn't strengthen. Raise Japanese borrowing costs and the maths breaks. The yen rallies, the loan gets more expensive to repay, and suddenly traders are losing money on both ends at once. So they sell foreign assets to buy back the yen rises further, more losses trigger more selling, and a feedback loop kicks in. And we don't really have to imagine how that looks like, because we saw it happen 2 years ago. In late July 2024, the BOJ raised rates by a tiny 15 basis points. The decision came on the July 31st. That was enough. On August 5th, the Nikkei dropped 12.4% in a single session, its worst day since Black Monday in 1987. The S&P 500 fell around 3%. The fear gauge spiked from 17 to over 65 within hours. Analysts estimated that a substantial share of yen carry trade positions unwound in the space of weeks, with some reports suggesting the majority of core positions were closed in rapid succession. And here, guys, is the part that should make you sit up and take notice, because that chaos came from a 15 basis point move. The June hike is expected to be 25 basis points from a higher starting base on a yen that is already under sustained pressure. When a carry trade unwinds, the sell-in is fast and indiscriminate. Liquidity vanishes and diversification fails at the exact moment that you need it most. And this begs the question of how an ordinary investor is supposed to track a risk that doesn't appear anywhere on their brokerage account. And that is exactly why you should be reading the Finance Bureau newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy, so that you never miss what truly matters. All you have to do is click the link in the description or scan this QR code on the right of your screen to get started. And now, back to how this Tokyo decision reaches into your account, because the carry unwind is only the first channel. The second is bigger, and it runs through Japan's role as the world's creditor. For decades, the logic was pretty simple. Why earn nothing on a Japanese government bond when you could earn more abroad? But that logic just flipped. The 10-year Japanese government bond yield touched 2.8% in May, the highest since 1996, and the 30-year broke above 4% for the first time since 1999. Suddenly, Japanese investors can earn a respectable return safely at home in their own currency with no exchange rate risk. And that changes everything about where the money flows. Indeed, we're already seeing it. In the first quarter of 2026, Japanese investors sold around $30 billion of US bonds. The chief investment officer at Blue Bay put it pretty bluntly, saying that the new money being put to work won't be going overseas, and it won't be going into US treasuries. Now, just think about the scale here. Japan owns over $1 trillion of US debt. If it brings even a tenth of that home, that is more than $120 billion of selling that the US Treasury market has to find new buyers for. And when there are more sellers than buyers, prices fall and yields spike. And this is when the effects reach you and your wallet. Higher Treasury yields feed directly into mortgage rates, corporate borrowing costs, and the value of every single stock that you own, because higher yields raise the discount rate on future earnings, which compresses equity valuations. And this is landing on a market that is already pretty fragile. US stocks have been carried higher by a narrow, concentrated AI trader, the kind of high-beta, momentum-driven positioning that gets sold first when funds face margin calls. And we indeed saw the early tremors on June 8th when the Nikkei fell over 3%, and South Korea's market triggered emergency trading halts at a near 7% plunge. That is the Japan effect arriving before the decision is even made. And here is the cruel part for the average investor. In a carry unwind, correlations collapse toward 1. Stocks and bonds fall together. The classic 60-40 portfolio that is supposed to protect you suddenly offers no protection at all, because both legs get sold simultaneously to raise cash. Your equity fund drops, and the bond cushion that is meant to soften the blow drops with it. But the stakes are actually much higher than what we've talked about might suggest, because Japan can't simply stop. It is trapped. Japan's debt sits at around 200% of GDP. The IMF puts it at around 204%, while other measures, including prefectural and local debt, push it even higher, toward 235 to 250% by some tallies, making it the highest in the developed world by any measure. And every single hike raises the cost of servicing that absolute mountain. Look at the numbers. Japan's record budget for this fiscal year is 122.3 trillion yen. Of that, debt servicing alone now eats 31.3 trillion yen, a record, crossing the 30 trillion line for the first time ever, and swallowing roughly a quarter of the entire budget. And that bill jumped almost 11% in a single year. And it was calculated assuming an interest rate of only 3%, the highest assumption that Tokyo has used in 29 years. So, the trap is total. If the BOJ doesn't hike, the yen keeps sinking, inflation entrenches, and it loses all its credibility. If it does hike, it piles billions onto its own debt bill and pressures the bond market already flirting with 3% levels that the finance minister treats as a danger line. So, they're damned if they do, damned if they don't. And this collides with a second tension between the government and the central bank. The government is running record spending and needs cheap financing for its enormous debt. The BOJ is raising the price of that exact financing. As one Monex strategist put it, higher spending cannot come without higher debt. The new Japanese Prime Minister actually once called rate hikes stupid, and then actually accepted them once inflation became undeniable. And that is the contradiction at the heart of all of this, and there is no clean way out of nearly 30 years of near-free money. So, let's bring this all the way home to your money right now. If you hold a US index fund, you own a concentrated bet on the very AI names that get sold first when the carry-funded leverage unwinds. If you have a mortgage to refinance, Japanese selling of treasuries pushes the rate you pay higher. And if you have a pension or a retirement account, it is stuffed with global stocks and bonds, the two things that fall together in a carry shock. And remember, a 15 basis point move in 2024 was enough to erase trillions in market value in a single week. This time, though, the move is larger from a higher base with positions that have been rebuilt since and stocks sitting near all-time highs. Central banks cannot wave this away. Japan is too leveraged to reverse course and too important to ignore. The volatility isn't a risk to some distant trading desk. It is a risk to the value of what you already own. And the people who understand this, they don't panic, they prepare. The August 2024 shock recovered within weeks, and those who knew what they were watching weren't blindsided by it. They reduced leverage, trimmed concentration in the most crowded trades, and treated the BOJ as to what it really is, a global liquidity provider, not a sleepy local central bank. For 30 years, the world ran on cheap Japanese money, the silent margin account behind every single major market rally. And that machine has now been switched off deliberately and permanently. The winners will be the investors who saw the mechanism and positioned for the turn. The losers will be the ones who felt the volatility without ever understanding why their diversified portfolio failed them at the worst possible moment. The same rate that Japan held in 1995 closes a 30-year circle, but it does so on top of a debt pile and global leverage structure that simply did not exist back then. And that is why a small move in Tokyo can shake the whole world. Plan accordingly. But what do you think? Does this June hike pass like a telegraphed non-event because markets had time to prepare? Or does it light the fuse on a carry unwind far bigger than we saw in 2024? Let me know your thoughts in the comments down below. And if you want to understand how the fragile AI trade could amplify all of this when the sell-in does start, then you can check out our video on that right over here. That's all from me today. As always, thank you very much for watching, and I'll see you in the next video. This is Nick, signing off.